Sometimes the timing of a corporate earnings call is just terrible. And honestly, that's what makes it so important. And that's exactly what just happened with MicroStrategy's Q4 report. It landed smack in the middle of a brutal market storm, giving all of us a rare, real-time stress test of their entire Bitcoin-centric model. Okay, let's dive into this. So, to set the scene here, things looked really grim. I mean, MSTR stock value just plummeted, hitting a 2-year low after dropping about 25% in only 5 days. Bitcoin itself was selling off hard, and the market was pretty much in a state of panic.
And it wasn't just the stock. Even a key part of their financing, this instrument they call Stretch, it fell to $93. Now, what makes that number a big deal is that it's below its $100 par value. Think of that $100 mark as its face value, right? So when something like this drops below par, it's a huge red flag. It's telling the market that investors are getting really, really nervous, showing deep stress across the company's whole financial foundation.
So, in the middle of this perfect storm, one story, and really only one story, just took over. The narrative you heard everywhere was that MicroStrategy was on the brink of collapse, that all their leverage was about to trigger some kind of catastrophic liquidation event. And really, this all boiled down to one simple, crucial question that everybody was asking. Does this whole ambitious model only work in a bull market? Or can the entire structure actually survive the kind of deep, painful drawdown it was going through in real time? All right, so here's how we're going to break this down. First, we'll look at the perfect financial storm they were up against. Then, we'll separate the hard math from all that market panic. After that, we'll dig into the new playbook that actually came out of all this chaos. And finally, we'll examine the big 7-year test the company has now set for itself. Okay, let's jump right in with that earnings call, because honestly, the timing was everything. Management had to step up to the mic right as fear in the market was hitting its peak. Now, on the surface, the headline numbers looked awful, a net loss of over $12 billion in a single quarter. But here's the thing, this wasn't a cash loss, it was an accounting loss, all on paper. It's because of rules that force them to mark their Bitcoin to whatever the market price is. The price dropped, so they had to report a massive paper loss. And for a lot of people on the outside, that was all the proof they needed that the whole strategy was blowing up. But management, they pointed to a totally different signal. They basically said, look, the real measure of our success isn't some paper loss. It's how well we're executing our strategy to accumulate more Bitcoin. And this slide shows their point perfectly. They pulled off a 22.8% Bitcoin yield for the year, which means they grew their holdings by a lot. This focus on accumulation, not just price, is the key to their entire strategy. All right, this brings us to the next big piece of the puzzle. This is where management went head-to-head with those liquidation fears, basically swapping out all that market panic for some cold, hard data from their balance sheet. So what was the actual number, the real liquidation price? I mean, you had the market freaking out with Bitcoin at $60,000. Meanwhile, management comes out and shows that the price would have to crash all the way down to $8,000 before they'd have any real trouble with their debt. Just a massive, massive difference. And believe it or not, it gets even more extreme than that. The key point management made was that the price wouldn't just have to dip to $8,000. No, it would have to fall 90% from its peak and then stay there for 5 consecutive years, all the way out to 2032. That's the scenario that would actually threaten them. And check this out, because this slide just completely flips that whole dangerous leverage narrative on its head. Everyone's worried about their debt, right? Well, their actual leverage is just 13%. Now compare that to your average utility company at 42% or real estate at 48%. The data doesn't lie. MicroStrategy is actually one of the least leveraged companies out there. Okay, so this brings us to what I think is really the core of this whole story. Because hiding under all that market drama, the earnings call revealed this quiet but really, really meaningful shift in how MicroStrategy talks about its long-term strategy and even how it measures its own success. And this slide lays it out perfectly. So back in Q3, you heard management talking about specific Bitcoin price targets, right? Like $150,000 by 2025. Come Q4, poof, all of that language is gone. It's been replaced with a focus on metrics they can actually control. Their Bitcoin per share yield, all modeled out in these new 7-year scenarios. So these new models, they totally redefine what success even looks like for them. It's not about just sitting around waiting for Bitcoin to hit some magic number anymore. Instead, The new goal is to grow the amount of Bitcoin they own per share of their stock. It shifts the whole focus to what they can control, skillfully raising money to buy more Bitcoin so that each share of MSTR represents a bigger and bigger piece of the total Bitcoin pie over time. That's the new game. Now, the engine that's supposed to power this new playbook is a concept they're calling digital credit. And it's a pretty radical idea. See, normally, companies get loans using collateral that loses value over time. Think buildings, equipment, that kind of thing. MicroStrategy's vision is to flip that. They want to create a whole new kind of financing built on an asset they believe will appreciate over time, Bitcoin. And if they're right, that should let them borrow money on way, way better terms. Okay, but what happens if those digital credit markets just aren't playing ball? Well, management has a plan B. They call it coasting. And the idea is super simple. If the borrowing terms aren't great, they just don't. They don't have to raise capital. They can just sit tight or coast and let the appreciation of the Bitcoin they already own do all the work. All right, let's get into our final section here and talk about the long-term vision. Because this new 7-year framework isn't just happening in a bubble, it's backed by a very specific worldview, and as we're about to see, it still faces some very real tests. So a huge piece of management's confidence here isn't just about financial engineering, it's actually about politics. They're convinced that there's this major structural shift happening in the political landscape, creating a policy tailwind for Bitcoin that they think the market is totally sleeping on. And they didn't just say it, they tried to back it up with data. On the call, they laid out this comparison. Go back 18 months, you could maybe find one government official in a key spot who was neutral on Bitcoin. Today, they count at least 12 who are openly pro-Bitcoin in significant roles. For them, that's not just a small change, it's a fundamental political realignment. But hey, let's be real for a second. This new vision, it's not a proven fact just yet. There are still some pretty big hurdles. That stretch instrument, it's got to get back to $100 and stay there. This whole shift to digital credit, it's still just a thesis, right? It's not reality. And at the end of the day, plain old equity issuance is still doing over 90% of the heavy lifting. So what's the big takeaway here? What's the one thing to remember? It's this. When you peel back all the panicked headlines and the noise, the company's actual financial structure is way, way stronger than the market was giving it credit for. The math holds up even under some really extreme stress tests. And maybe just as important was the change in their tone. For what felt like the first time, you could hear a new sense of patience from management. They actually sounded willing to slow down that relentless pace of buying Bitcoin if it meant they could rebuild some credibility with the market and let this new model really take root. And that leaves us with the final big question. Is this new 7-year playbook a stroke of absolute brilliance, something that's laying the groundwork for a totally new kind of financial institution? Or is it just a really disciplined pivot, a necessary course correction that's been dressed up to look like grand ambition? Well, that's the question, and the market is about to decide.